Let's get into Schedule P, and I think you'll see why I find this such a great wealth of information for an insurance company. This is statutory accounting, and we'll talk GAAP accounting as you learn in most of your finance classes versus statutory accounting, which is the accounting the state regulators require. The statutory accounting is just incredible levels of detail, pretty amazing. You'll see as we get through this entire financial statement how important the actuaries are to the accounting of insurance companies. The accountants just really cannot produce the biggest numbers on the blanks on the financial statements. But we're going to look at Schedule P. We'll spend a little bit of time here on Part 1. We won't spend a whole lot of time on Part 1. We're going to be really focusing on Parts 2 and 3. But it's a miniature, Part 1 is a miniature income statement. It says it's analysis of losses and expenses, but it has a little bit more information than that. The first set, well, first of all, you have all your years. So these, when it says earned and incurred, put in your notes, earned and incurred, we're talking about a fiscal year, accounting year type of analysis. So we're going to have accident year and fiscal year. Fiscal year is earned and incurred. So we'll see. I mean, it's going to kind of depend on which schedule we're looking at. But then the premiums earned every year, you have direct premiums. That's the insurance they sell directly to their customers. Assumed are, and I don't know if Allstate does much reinsurance assumed, but assumed is when an insurance company sells insurance to another insurance company. So they become the reinsurer, and so they bring that in. And then ceded is the insurance they buy from a reinsurance company. So Allstate might go out there and spend $458 million, $459 million. They may buy that from Swiss Re or Munich Re. And so their net premiums are the direct and assumed minus ceded. So that's their net premiums. And then you get into losses, again, direct and ceded, your defense costs and other loss adjustment expenses, the losses and loss adjustment payments, direct and ceded. Again, when you're buying reinsurance, it covers more than just your claims. Adjustments and other payments, which is a fairly substantial number there, but still smaller than the others. So the biggest number is your loss payments, and the adjustments and other payments is second, and then your defense costs is third. Then you have salvage and subrogation. I don't know if we've talked too much about this, but salvage and subrogation. Salvage is when something gets damaged, a car, let's say, is in an accident, and let's say they total it. Well, if they total your car, the insurance company now owns your car, and they're going to pay your claim. You're responsible for the deductible. They'll pay your claim and replace your 3-year-old car with another 3-year-old car, or they may give you cash. But now they have your car that was totaled. Salvage is they get to sell off the tires and any parts of the car that are salvageable. They get to sell it off to a junkyard or wherever they go. Subrogation are lawsuits. So salvage and subrogation. Subrogation is a lawsuit. So you're in an accident and the other driver is at fault. When you buy insurance, you're essentially giving up that right to sue that other driver if your insurance company pays the claim. So if they pay your claim, they have the right to sue the other party. If you go out and you try to sue and try to get your own payment, then you're essentially jeopardizing your own insurance. So salvage is the physical things that they can sell and get money for. Subrogation are those legal costs that they can get reimbursed because the other party was guilty. And so your total cost is again, your direct minus your ceded for all of these items. Now they keep going, so they have unpaid losses. We're going to talk quite a bit about these. You have the normal ones and you have the IBNR. I'm not going to get into too much difference between case versus bulk. Then you have defense and containment unpaid, and you're adjusting. So it's very similar to losses, defense, and adjusting. For some reason, they're breaking out case basis versus bulk and IBNR. We talked about IBNR, incurred but not reported earlier. You can see it's a really small number for Allstate, as you would expect. But so these are the incurred numbers. This is the actual what they had, but then not everything got paid. So these are the unpaid parts, and that's where we're getting into the to the loss reserves. So, and again, you have salvage and subrogation. That's anticipated. They haven't received it yet. So this is received, and this is what they're still expecting. And then your total net losses and expenses unpaid, net of salvage and subrogation. And then you get the totals. Oh, I'm sorry, I misread this one. Let's go back to the first column. This first column up at the top is payments, that's cash. The next section is the unpaid, and so the last section is the incurred. I was doing it backwards. I was thinking it started with incurred, but the last section is incurred. Incurred is simply the paid plus the unpaid, and that gives you the incurred. Then they give you the loss ratio, loss and LAE ratio. Remember, we talked about the combined ratio. So this is the combined ratio, but without expenses and without profits. So this, remember the combined ratio, we were seeing numbers like 95, 96. Well, this is the loss ratio part, our loss and LAE ratio part of it. It excludes the expenses. So expenses might be 20, 25%. So you add that on top of that, and you get about a 95 combined ratio. So the combined ratio is the loss ratio plus the loss expense ratio plus the expense ratio. They don't have any of this material. And then they show you reserves. We're going to talk about reserves when you get in the part 2. So some good information there. You can definitely look over time and see what kind of numbers these are, if they're growing, how large are they. So let's get the Schedule P Part 2. I love Schedule P Part 2. We won't work a math problem this time, I don't think. Well, we'll see. We're doing okay on time. So I might introduce one real quickly to you. All right, so Schedule P Part 2 are the incurred losses. Now this is on an accident year basis, and it's on an accounting year basis. All right, so what you're seeing across is what they reported in that accounting year, but they're keeping it by accident year. So the business they wrote in 2010, here's what they thought their losses were going to be as of 2010. So 2010, the accident year and the calendar year are the same estimate. But then in 2011, and this is real important, these are losses. In 2011, let's increase this some just to make sure everybody can see it. I don't know what kind of computer you're looking at this on. So you'll notice in 2011, they changed their mind about 2010 business. They did think it was going to cost them $15.2 billion, but now they think it's only going to cost them $14.9 billion. So what we're going to talk about is, what did they do to their financials in 2010? Well, in 2010, their expected losses were $200 million more than what they expected at the end of 2011. Obviously, this is a better estimate than this because they have more information. And so they overstated. You can see they went from expecting $14.9 billion in losses. They went to, that's their newest estimate, but last year, or in 2010, they thought it was 15.2. So they overstated their losses by $200 million in 2010, which means they understated their net income. Then you come to 2012, where they take another 150 or so million out of their estimate. So they overstated 2010, and then 2011 was also overstated. So you can see they've gone from 15.2 to 14.8. That's about a $400 million difference. So they understated net income, or they overstated losses in 2010. As far as we know, as of 2012, they overstated 2010 by $400 million. And so they improved it by $200 million in 2011, another $200 million there. So 2011's net income was overstated by $200 million because they corrected the mistake they made in 2010. And then 2012's net income was overstated by another $200 million because that should have, the $200 million they added back here and the $200 million they added back here should have all been in 2010. And so as you go across, you notice they keep coming down, but it's not coming down as much. But you notice each year it tends to come down. Now 2016 they added a little bit, but then they drop back down. So 2017 is still higher than 2015, but they drop down, so it can move around a little bit. And now you get to the very, very last year, 2019, that's their best estimate, 14.6 billion. They started thinking 15.2, so $600 million. So if you're doing an analysis of State Farm, their 2010 claims and expenses in LAE were overstated by $600 million based on what we know as of today. So this should be our best number. What we know today should be our best number, 14.6 billion. Obviously, it can change again next year, although this one will roll off and go into that top line next year and just be part of that line. But so their 2010 claims and expense and loss and LAE expenses and claims were overstated by $600 million, which means their 2010 net income was understated by $600 million. Now you think about that, I'm going to jump up, let's see, we're on page 197, 198. I'm going to jump up to the very, very beginning and just show you, let me see if I can find this. I can find a schedule that will really help us. Hopefully there's not too many. All right, here he is. Okay. So they'll show their net income. We'll get to this schedule, but they'll show their net income. Their net income in 2015 was $1.7 billion, and it was 1.4. So they make somewhere in the neighborhood of $1.5 to $3 billion. I don't know what it would have been in 2010, but if 2010's net income was understated by $600 million, you can see that's not an immaterial amount of money. It's, you know, over a third of their income, and probably more than that in 2010. I imagine their 2010 was much, much lower. So this is important. Material numbers. If you look at GAAP financial statements, which is your finance major and you're analyzing Allstate, all you're going to get is the GAAP and most of your resources. Bloomberg and Bloomberg machines do provide some statutory data, but not a whole lot. It's somewhat limited. You certainly don't get the Schedule P data like this. And so if you're looking at the company, I would actually recommend you go back and adjust their net incomes as much as you can for these changes that the actuaries are seeing. Now, if you come up to a year, I wish I could show a year where we had a major hurricane. I guess 2017 was Harvey. It doesn't look like it. Trying to see a big jump, so I'm not seeing Harvey in that number. But you know, you look here. They expected to be 18 billion, and they dropped down to 17.9. So not a big difference. Very small, in fact, from 17 to 18, very small difference. You look at a product here, 2015. They originally thought it was 16.9 billion. Now they have 16.8. Not a huge difference. Not a big difference. Not a big difference. There's about 600 million. But if you think about each one of these, one thing you'll notice: 15 to 14, 16 to 15, 14.8 to 14.6, 14.2 to 14.1, 15.6 to 15.5, 16.9 to 16.8. You notice every single one of them, they've come down. This is the only exception. 2018, they actually increased their reserves. So if you think back to Warren Buffett and what we talked about with their annual report in Berkshire Hathaway, he said he didn't like the idea of discounting reserves because insurance companies tend to under-reserve. You sure don't see that with Allstate. Allstate it looks like they actually do a pretty good job of reserving because their initial estimates are almost always greater than their final estimates. Now, I keep asking actuarial students to explain. I don't understand this prior line. Doesn't make sense to me. My guess is there's something more going on that. This is the one where you'll see the biggest change, but I do think there's more going on with that. But anyway, this is Schedule P, so be real careful. These years across the top are the accounting years, and they're showing you what reserves what total incurred losses they expected in these accounting years. And if you compare it to the previous year, it'll tell you how much that particular accident year impacted that particular fiscal year. Coming down here, these are the accident years. And actuaries think in these terms. So, someone might say, wow, we had a terrible 2010. And actuaries say, well, no, actually 2010 was pretty good. And the accountants say, no, we made $200 million less than we normally do. Actuaries would say, yeah, but our reserves are $600 million too high. So we really made $600 million more that year than we reported. Accountants don't buy that argument at all. They don't listen to it. It just, most accountants, it's like, what does the financial statement show? What is reporting number? So don't mix the accident year versus the fiscal accounting year. This is also true in life insurance as well. They keep track of each product they sell by the year that they sold it, and they have an incredible amount of information. It's really a pretty incredible financial analysis that the actuaries do. All right, so what does this have to do with Schedule P? So let's look at Schedule P. Schedule P is how much has been paid. So Schedule P Part 3 is the paid losses. Schedule P Part 2 is the total losses. All right, so this is everything we expect to pay, $15,178,000,000. As of 2010, they had paid $9,451,000,000. So a few things have to be true. First of all, Part 2 must be greater than Part 3. There's no way they can pay more than what they expect to pay out. So Part 2 is what they ultimately expect to pay out in total. Part 3 is what they've already paid out. And you'll notice Part 3 will increase year after year after year. Eventually, it doesn't change much, but it still changes a little bit. Even if it's a firm like Allstate with a lot of short tail lines like auto insurance and homeowners, they do have bodily injury claims that they have to pay and other things that do have several years to go. So if you look at this, again, I can't explain the prior year. You notice it's 0. I think this is just covering everything that's the last 10 years. But if you look, in 2010 business, they expected $15.2 billion, but they only paid $9.5 billion. Well, the difference in those two are the reserves they're going to put on the balance sheet. So let me jump back to the beginning of this financial statement, and I'll show you page 3, which is the liability section of the balance sheet. We'll get into this. But the liability portion of the balance sheet, you have your losses, and this is liabilities. So there's your loss reserves, $13 billion. That is the total of all the ultimate incurred claims they expect to pay minus all the years that they have actually paid, all the claims that they paid over time. And so that's how much unpaid they have. Same thing in loss adjustment expenses. So you take all the loss expenses they ultimately expect to pay on the business they've already written to date minus what they paid to date. So that's what this schedule will, if you do the numbers, you can't tie it by exactly. So if you just take this column and add it up and subtract this column, everything in this column, you'll get something very, very close to the reserves. Remember, this is loss and LAE. So it's a combination of numbers that it may not be exactly to tie this back to the statement, but you actually get pretty close when you do that. All right, so what we're going to do, I'm going to give you some, we'll do it next session because I want to do the problems and see if you can handle these schedules. But what we're going to do is we're going to calculate things like, well, we'll talk about the 1 year and 2 year development. Well, let me just tell you real quick. We got about a minute here. The 1 year development, you simply take the 2019 number minus the 2018 number. If it's positive, then they add it to the reserves. If it's negative, they reduce reserves. So you can see most of the numbers are negative. If you added this up, you get a negative. So that means last year's net income was understated by $83 million because they had more in reserves than they needed. And the 2 years, the exact same thing. You just take 2019, you just subtract 2017. So one of the things I ask you to provide on exam is the 1 year and 2 year development. The other thing I ask about, a second thing I ask is the given reserve. So I might ask you for the reserve for this 2017 business. So you just take the 2017 total expected incurred minus the 2000 paid to date, and that will tell you the reserve for that business for that year. And the other question I ask is, how much was a 1 year's net income misstated, higher or lower, due to the adjustments they made in their ultimate payout? So those are the 3 questions I ask. Next session, we'll walk through those 3 questions, and you'll see how they actually work.